Today my guest is Terry White. Terry is the founder of Sunwest Trust Incorporated. He's also an author of When All You Have Is a Hammer, an informational guide to self-directed IRAs. And we're going to talk with him about self-directed IRAs and more. But first, a quick reminder, if you like the show, please let us know. You can like, share, subscribe. We would love to hear from you. Also, if you'd like to check out how handsome our guests are, be sure to check out our YouTube channel. That's Commercial Real Estate Pro Network. All right, with that, I want to welcome Terry White. Terry, welcome to CREPN Radio.
Thanks, Darren. I appreciate it. Enjoy the opportunity to talk to you and your listeners.
I'm looking forward to it. The topic, self-directed IRAs or IRAs, is something that I think is tossed about a lot. I don't know that it's fully understood by everyone, and it might be one of those things that somebody's out there been thinking about, or maybe the opportunity, they didn't realize it was a good opportunity, good fit right now, but this will be good nonetheless. Before we jump into our conversation, if you could do myself and the listeners a favor and share a little bit about your background.
Well, I actually have a degree in accounting from the University of New Mexico. I'm located in Albuquerque, New Mexico. And once I got my degree, I squeezed 4 years into 5. And when I got my degree, I got a job as controller for a title company here in New Mexico, the largest title company in New Mexico. Did that for 4 years. And then basically in order to keep from getting fired, I quit and started an escrow company, which some of your listeners might not be familiar with. But what that is, basically it's a mortgage servicing company, but for owner financing. So we service owner financing on real estate all over New Mexico. And then in 2004, we started Sunwest Trust. And so I still have the escrow company, but in 2004, we started accepting self-directed IRAs. And now we're a little over 10,000 IRAs. We've been in business about 14 years in that particular business. So, the interesting thing about self-directed IRAs, Darren, or at least to me, I'm one of those nerds. All this stuff is interesting to me, but every IRA is self-directed. Most people don't realize that, but the difference is the custodian that you use can determine what kind of assets you can invest in. So your brokerage houses, those people will let you choose any marketable stock that you want to. So it's self-directed in that realm. What's come to be known as the self-directed IRA, like we do at Sunwest Trust, is a custodian that allows you to invest in what I would term non-traditional assets. Traditional assets being stocks, bonds, mutual funds. But what we do is we let people invest in anything that the IRS does not specifically prohibit.
Got it. That's the most succinct explanation of IRA. I mean, from a standpoint of self-directed, because I think most often it feels like it's tangled up with an employer-selected point person or whatever, and while you made clear the direction that you can provide, it's usually limited to a fairly narrow bandwidth of opportunities that they provide, but yet you are directing with that bandwidth.
Yes.
So let's talk about now that you've made clear that there's that all IRAs are self-directed. Just probably a matter of if you're employed, are you prohibited from directing your IRA outside of your employer-sponsored?
Well, there are several different things. When you're talking about, having what's called a defined contribution plan within an employee-type relationship, that's typically going to be a 401k, a 403b, maybe in some cases a simple and a SEP. All of those are typically what you can invest in those kinds of retirement accounts are typically governed by the plan administrator or the employer. Now, what we do is we allow self-directed IRAs, which everyone probably knows that stands for individual retirement accounts. So those are individual accounts that you have regardless of your employment. they go with you individually and they're not dependent upon employment. So the 401ks, 403bs, those kinds of things can be invested in non-traditional assets, but that's typically governed by the plan administrator, and the vast majority of those probably don't allow for investments outside of a small pool that the employer decides is something they want their employees to be able to invest in.
Is that primarily due to a liquidation? Do you have any sense of that, or is it more what the product that the people that got the plan and ran with it, the stockbrokers, presented?
Well, it's really probably more of an administrative thing. Most banks, most brokerage houses will not allow you to invest in non-traditional assets simply because it's a little more difficult. It's a little more work on our part. We have to be a little more familiar with how do you buy a piece of real estate, what documentation has to take place, how do you buy a private company stock, how do you lend money out of your IRA. So as opposed to a brokerage house where they just strictly say, you can buy anything on the New York Stock Exchange, that's a much less administratively taxing investment than buying a piece of real estate in Portland, Oregon, or a piece of real estate in Albuquerque, New Mexico. So most of the banks and stuff, although they could allow the kind of investing we do, they typically don't, just because of administrative difficulty, I guess.
Gotcha. So let's talk a little bit about who is eligible, because obviously if you're with an employer, it sounds like there might be some challenges as far as directing your employer-sponsored plan outside of that. So who do you find that's typically one of your clients that you takes advantage of the self-directed IRA?
Well, our typical client is usually someone who has been working for a company and had a 401k. So they've had an opportunity through a 401k to build up a sizable amount of money. And then when they leave that company, they have the option to either leave the 401k where it is and leave it invested where it is, or they can roll that out into an IRA. And so those are the typical clients we have, because you're self-direct, and we'll just use the term self-directed for what we do. I didn't mean to confuse everybody at the beginning, but so a self-directed IRA is typically investing in things that are a little more expensive. So, if you're just starting an IRA and you could only make a $5,500 contribution, you're probably not going to go out and try to buy a piece of real estate with it because you just don't have enough cash. Right. So the average size account that we have here at Sunwest is about $130,000 per account. And you typically, I tell people, you probably have to have at least 50,000 to really be able to do much. And the other thing that you have to keep in mind, Darren, is we charge a fee for the service that we provide. Your stock, your brokerage houses and your banks don't charge fees for their IRA because they earn a commission on the sales of the investment, or they're earning interest on the money you have in there. Sunwest Trust and custodians like us don't participate in any kind of fee sharing. We don't sell anything. We do exactly what our client tells us to do as far as investing. So because of that, we charge a fee for the service of acting as custodian. And so one thing you have to take into consideration is the fee that I'm going to have to pay a self-directed IRA custodian as a percentage of the money that you have to invest. So in other words, if you only had $1,000 to invest, and here at Sunwest we charge $275 a year to act as custodian, I mean, you're going to have to make over 27.5% interest just to break even.
Right.
So that in my mind dictates the fact that you need a little larger account for the returns that you get to be able to pay your fees and still make a reasonable profit.
But in that fee, is that a flat fee?
Well, yeah, we're one of the only custodians probably in the country that just charges a flat fee. We charge $275 a year regardless of how many assets you have in your account or how big your account is. I would encourage people, if they're thinking about doing a self-directed IRA, to get on the internet and do some searching and find out whose fees work best for what they're planning on doing. Most companies charge a fee based on the asset value of your account, and it decreases as your asset value gets larger. The percentage decreases. Then some people charge based on number of assets in your account. There's just lots of various ways that they charge. Sunwest just charges a flat $275 a year, and then we charge a small $10 transaction fee when you make an investment.
Got it. So let's talk about, you mentioned the average size of an account, about 130,000. Can you describe some of the strategies or some of the assets that your clients have invested in or used their self-directed IRA to invest in?
Sure. Well, the thing is, the IRS does not tell you what you can invest in. They tell you what you cannot invest in, and they basically say you cannot invest in life insurance or collectibles. So that leaves everything else open. So I would say the majority of our business people are invested in real estate or real estate related type things. Maybe they're lending money to someone to buy real estate. Maybe they're lending money to someone to buy and flip houses, that kind of thing. Probably the next biggest chunk would be people investing in private companies. One comes to mind years ago when I used to actually do the work around, some of the work around here. I've never done all the work around here, but we had a guy that contacted me that his neighbor was going in the beef jerky business. He was going to start a business and make beef jerky. And so this guy wanted to help him out and invest with him. And I'm not sure how that turned out, if it turned out to be a good investment or not. But those are the kinds of things you can do. We've even had people invest in racehorses. We've had people invest in cattle. It's just almost as big as your imagination. The only things you have to be careful of, you cannot deal with a disqualified party, and disqualified parties are yourself and your ascendants and descendants. So you can't your IRA cannot buy something from you, and your IRA can also not do any business with your kids, your grandkids, your parents, your grandparents. It's interesting, the IRS does not define family as your brother, so your IRA could do business with your brother or cousin, that kind of thing.
Oh, interesting. I knew there was some sort of a limitation up down, but I didn't know that you could go left to right, I guess, with the brother sister kind of thing.
Yeah, it's interesting.
Yeah. So describe for me, the within the real estate. Do you find that people are typically buying a single property? Are they investing with others? Are you aware of that at the time? I mean, is it?
Well, I'm aware of that a little bit. I mean, there are a lot of people that are buying single family homes or small, they buy them themselves. So they buy maybe a fourplex or something like that. I would think, and I don't know for a fact, but I would think if you get much bigger than that, the dollar amounts get large enough that they probably just, go into some kind of syndication or something, or maybe they form a limited liability company where several people can go in together and buy something a little bigger. But frankly, I don't know what kind of commercial property our clients are holding. As I alluded to before, I don't really do any of the work around here anymore, which is kind of nice, but it kind of removes me from the kind of things that people are investing in, knowing about those.
Gotcha. So as far as the services that you guys provide then, let's say I've just left my employer. I've got an account I want to roll over. I've got an opportunity to invest in some real estate. And I know that I can use my IRA money to do so. Describe the path from that point to investing, how that works for you guys.
Well, there's a couple of ways, and I'll describe one, and then if we want to go further into the other, I'll be happy to do that. Let me point out just real quick, if people have a more interest in some of the topics that we touch on, Sunwest has a YouTube channel called Sunwest IRA, and on that YouTube channel, I have over 230 videos, just short 5 to 7 minute videos that describe a lot of these things. Okay. But let's say someone wants to buy a piece of real estate. Let's make it simple and just say they have enough cash in their IRA to pay cash for a piece of real estate. They want to buy a single family residence. What they would do is they go out and find the property, and they can negotiate for the price. And then once they get to the point where they're going to create a purchase agreement, the purchaser of that property is going to be Sunwest Trust as custodian for Darren Gross IRA.
Gotcha.
So a lot of people make a mistake and they just put Darren Gross and or assigns, and they think, well, later I can assign that to my IRA. But as I told you before, you're a disqualified party. So the simple fact of assigning a purchase agreement from yourself to your IRA is a prohibited transaction. So they would negotiate that purchase agreement. They would create it in Sunwest Trust name as custodian for their IRA. And then they would direct us to sign the purchase agreement and issue a check for the earnest money. And then once the title company has done their title search and everything, they're ready to close, then the account owner, the IRA account owner, would then direct us to issue a check for the closing on the property. And the title to the property, again, would be Sunwest Trust as custodian for the individual IRA. And then we hold the property. If they rent it, there's some question about how much you can do as the owner of the property, as your IRA being the owner of the property. I think if you wanted to be 100% conservative, you would hire a property manager to go out and find people to rent it and do all the things that a property manager does. But I also, on the other side of it, I encourage people, they need to talk to their own CPA or tax attorney. That's my disclaimer. But I think you would be allowed to, run an ad on Craigslist and interview people to rent the property and maybe fill out the lease agreement, but then the checks, they would have to make their checks payable to Sunwest Trust custodian or Sunwest Trust with an account number on it. And so all of the rental income from that property would come back into the IRA, and any expenses on that property would be paid out of the IRA. So again, the easiest way to do that would be to use a property manager and have a lot of those transactions run through the property manager.
Gotcha. Quick question. You mentioned originally we were talking about the lineage ancestry thing. You couldn't go up, down, or yourself. Mm-hmm. So it's my IRA. I'm not buying the property to live in, but I'm certainly buying it as an investment. It's titled to the trust company, Sunwest Trust, care of my IRA, correct? Mm-hmm. And that right there is a I guess defined as not being not allowed. Because it's not my residence. It's not for my use, but more of as an investment.
It's an investment. Yeah.
Gotcha.
Yeah.
Okay. Gotcha.
So an example, kind of, Darren, that we've run into is people buying a piece of property in Costa Rica.
Right.
And then, so their IRA buys a piece of property in Costa Rica. And then the next thing they tell me is, I'm going to go down there and stay in it for 2 weeks. Yeah. You can't do that. And the kind of the frustrating thing about that is, even if you pay the amount of money that you charge everyone else, you still can't do that.
Right.
So that's, you have to look at this. I tell people, kind of look at your IRA as a whole nother individual or a whole nother entity, and that you don't want to give them money and they don't want to give you money. It's theirs, and keep that separate from your own personal assets. And just keep in mind that it always has to be separate.
Gotcha. So in the example you just kind of laid out, we talked about somebody's got enough cash to buy the property outright. And I've heard the term, and I know there's some boundaries or some issues that come into play. I'm wondering if you can speak to them at all. Specifically, if you're using leverage to buy a property, can you speak a little bit to that? How you guys?
Absolutely, that's a great question. A lot of people don't realize this, but you can have debt. Your IRA can have debt. So if you don't have enough cash in your IRA to buy a piece of property outright, you can borrow money. And there are lenders out there that will lend money to an IRA. The key is that the debt has to be non-recourse, meaning that the lender, if the IRA doesn't pay the payments, the only thing the lender can do is take the property back. You cannot personally guarantee that loan, and they can't go back against the owner of the IRA for any kind of deficiency judgment. So it has to be a non-recourse loan. The other thing to keep in mind about having debt in your IRA is that triggers a thing called unrelated finance debt income. And so what you need to do is you take the property and you calculate what the depreciation was on it for the year, the interest that you paid on it, all the things that you would normally get to deduct if it was owned outside your IRA. And if your property has a profit, then you have to apply the percentage of debt against that profit, and you will have to pay taxes on that percentage of the profit. Does that make sense? It's a little more complicated than that, but
I think you made it clear enough for me in the percentage there. So if just example, you have 25% of the purchase price comes from your IRA, you borrow 75%. If I understood what you just said, just in basic terms, that 75% of that income would then be subject to the UDFI tax. Is that, did I?
yes,
Okay.
yes. And so, yeah, 75%, but then the IRS in all of their, being as kind as they always are, they will allow you to have the first $1,000 without taxing it.
Okay.
Annually. So, as an example, if you multiplied the 75%, you came out with $10,000, you would pay tax on $9,000, and you would need to have your accountant create a form called a 990T, and then you would pay the tax on that out of your IRA.
Gotcha. And I assume that's ordinary income tax rates then, or do you know? Or?
No, it's worse than that. I think it's trust tax rates, which I think are a little higher. I'm not a tax person, but I think they're at a higher rate. So it doesn't make a lot of sense probably to, a lot of people will tell you, Darren, that you shouldn't own real estate in your IRA because real estate has its own tax advantages.
Right.
And you lose some of those tax advantages by having it in an IRA.
Right.
And I don't disagree with that, but I think a lot of times maybe the IRA is the only place that an individual has a sizable chunk of money that they could do something with, that they could buy a piece of real estate. And just me personally, and it's my own personal opinion, I'm a big believer in real estate. I've invested in it for the last 35 years, and I've generally made money. And I like the fact that it's tangible. I can drive down the street and say my IRA owns that house.
Right, right.
So
let me ask you, because I know, I think a lot of times we focus when we say real estate is the asset itself, actually acquiring the asset and holding the asset. What about lending money? Is that something you can do from the IRA?
Absolutely. Absolutely. I have a great story that a couple of years back I was talking to one of our clients, and it was, I assumed she was an elderly lady. I guess I shouldn't do that. But she had a nephew that was flipping properties. And so he would buy properties, obviously, and fix them up and then turn around and sell them. And he was in a position where he needed cash. Well, obviously, the nephew is not a disqualified party for this lady. So she began lending money to her nephew for him to then turn around and buy real estate and flip it. And she created a situation where she only got an interest rate return from him, maybe a above market rate. I don't know what it was, maybe 6, 7, 10%, something like that. But you could also create an agreement where you get an interest rate return, maybe plus a piece of the profits on the property. So I think lending money out of your IRA, on a secured basis is probably a reasonable thing to do. We see a few people lending money out of their IRAs unsecured, and I'm not too excited about that, but it's an allowable investment.
Is that anything you guys handle the collection through your escrow company? If somebody came to you with an opportunity like that, could you handle that?
We absolutely can, yeah. In fact, we require, if you're going to lend money out of your IRA, we require that you have a third party administer the loan. It doesn't have to be us, and there are other companies out there that can do it, but we require that simply because that way they keep track of the interest and that kind of stuff and make sure that the amount collected is correct and all that.
Right.
So we require that.
And then I assume you provide the statements year-end for taxes and all
yeah. Now,
that.
so the income that comes back into your IRA, if it's a traditional IRA, that's tax-deferred income.
Oh, right.
If it's a Roth IRA, it's tax-free. So the only thing that we have to file on an annual basis, there's a few things we have to file. Number one is we ask the IRA account holder for a value of the asset every year. So we have to report to the IRS what the assets within your IRA are worth as of December 31st at the end of every year. So because we're dealing with a wide variety of assets in a wide variety of locations, there is no way for us to value those. So we ask the individual to provide us with that value. And we have to report that on what's called a 5498. That is a form that we send to the IRS, and this confuses people sometimes. We're not required to send that form to an individual until the end of May every year. So we get a lot of calls beginning the first part of next year. We'll get a lot of calls, people saying, I haven't got my 5498, I can't file my taxes. Well, we can't give you your 5498 until May because you have until April 15th to make a contribution for the previous year. And that has to go on the 5498 too. So if I were to give you a 5498 in February, and then in April you decided to make another contribution for the previous year, we would have to amend that 5498. So the IRS just tells us they have to be mailed out by the end of May.
Gotcha.
The other thing we do, just real quick, the other thing as a custodian is if you take a distribution from your IRA, then we issue you a 1099.
Gotcha. So that's probably the majority, I would guess, if people are taking distributions, that's I would think that'd be the lion's share of what you guys are doing as far as providing, paperwork.
Yeah, you have people, you have this thing with a traditional IRA account, you have what are called required minimum distributions.
Right.
And so when you turn 70 and a half, you have to start taking those, and we're required to notify you every year and do that calculation if you request us to, and then make sure that that we send those out. Now you have to ask for them, but basically, both of my businesses, the escrow business and the trust business, are both basically just record-keeping businesses. That's what we do, is keep records.
Sure.
And some filing.
A thought just occurred to me. So you have an asset in the 40 or the IRA that's a real estate piece of real estate. You've turned 70 and a half when you've got to start making withdrawals. How is that accomplished if I've got it paid for? It's loan free. It's all the cash is tied up in the asset. I mean, I've got the income that's being generated from it. How is that accomplished?
Well, that's a great question, and unfortunately, people don't think ahead. What I would recommend is people just kind of think ahead, and when you're getting close to that age, 68, 69 years old, you might think about selling that piece of property so that you have the cash to take out as distributions. But the other thing is if the property's cash flowing, the cash flow itself might be enough to meet the required minimum distribution requirement. The other thing is, again, we said you could take a loan, so you could borrow money against that house to take out in cash. And then the last and probably the least desirable thing would be to take a ownership interest of that house out every year as a tenant in common percentage. The problem with that is you're taking out an asset that you have to pay taxes on, but you're not getting any money. So you need to have some money somewhere, some actual cash somewhere to pay the taxes.
Right. No, that's interesting. I hadn't thought that one through that far with the, I know there's a fair amount, and I talk with quite a few syndicators, and I know that they raise quite a bit of money from self-directed IRAs, and it seems like it's a pretty good opportunity for everybody involved in that situation where you have a large asset, you have pooled resources from your different investors, whether they use Sunwest Trust or another self-directed IRA company. But you get all that money, you're in, you're out in 5-7 years or whatever, and presumably, for the last 10 years, everybody's been singing a pretty happy song.
Yeah,
everything goes well. But the rarely do I hear any discussion about the UDFI or And I guess it probably doesn't apply as much for a lot of the people that are doing that about the turning 70 and a half and,
Yeah.
having those issues, especially if you're going to be out shortly there. But interesting. Do you have any sense of the numbers of people that I thought you mentioned, what, 10,000
We have
accounts?
about 10,000 accounts now. Yeah.
And of those, do you have any sense of the numbers that work in syndication kind of stuff? Or
No, I really don't, because again, we don't keep track of it that way, and because we don't sell anything or anything. We just do what people tell us to. So we can go back kind of after the fact and look at real estate, the asset of real estate or the asset of a limited liability company or the asset of precious metals, and look at those as a percentage of our totals. But within the real estate area, I don't know exactly what that is, if it's single family homes,
sure,
syndications, that kind of thing. The one thing I'd like to point out just real quick is, and I hesitate to say this because it's kind of against what I do for a living, but self-directed IRAs are not for everyone. The reason I say that is because a lot of people don't understand. First of all, they don't understand about investing, and there's nothing wrong with that. It's just maybe they're not interested in that. But, if you don't understand what you're investing in and how you're going to get paid back and how they're going to generate the money to pay you back, all those kinds of things that are pretty basic, you probably shouldn't be investing in that
right.
particular thing. You probably should keep your money in the mutual funds or with a stockbroker or somebody managing it for you. The other thing to keep in mind is since we're talking about real estate and RMDs, keep in mind that as you're getting closer to that age, if you have, say, 100 grand in your IRA, you probably shouldn't invest all 100 of it. Maybe you should look at maybe 70,000 of it or something so that you have that extra cash, not only for the RMDs, but even if you're younger than that. I don't know if you own real estate, but I've owned real estate over the years. And when you least expect it is when you need to put a new water heater or a new roof or, some repairs. And if you've invested all of your available cash from your IRA into this piece of real estate, then you're kind of between a rock and a hard place because it's hard to get, you can only make a $5,500 contribution annually, or 65 if you're over 50 years old, but sometimes that's not going to be enough. So I would tell people, you need to make sure you understand what you're doing, do your research, get a good team behind you of people that a realtor, a lawyer, a tax accountant, people that understand this business before you jump into it. One thing we didn't get to say is there are 42 million IRAs in the United States. And of that, it's kind of hard to tell, but we guess that there's about 3 to 5% of those are self-directed. And so, that means there's a huge opportunity for a business like mine. But the other side of it maybe is that 95 to 97% of the people really shouldn't be investing in it, something self-directed. I don't know.
Well, I think knowing more is probably a good starting point.
Yeah.
It's one thing to be all excited about an opportunity, but if you're only half thought, half baked, you might have a problem you didn't intend on.
Mm-hmm.
But I appreciate you sharing, and talking a little bit about some of the, I don't want to say the pitfalls, but just some of the boundaries and some of the things to be aware of. With that, the requirement that you've got to start making your required minimum withdrawals, and then a little bit about the UDFI and stuff. But I think that, like you identified, majority of people, that's where the lion's share of their money is
Mm-hmm.
in an IRA. So if they want to do something different than the stocks, bonds, and mutual funds or whatever, then this is an option. So that's great.
Yeah. 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 And I appreciate shows like yours and other shows that I've been on, because I think education is extremely valuable. I mean, you can't make a good decision if you're not educated about what you're going to do. So listening to shows like this, our YouTube channel, I offer my book for free if you go to my website. I would encourage people to do research before they jump into something like a self-directed IRA. It sounds kind of self-defeating because I'm in this business and I'm maybe trying to talk people out of it, but in the long run, if you get into a self-directed IRA and you're happy and it works well for you, you're a much better client than the guy that gets in and doesn't know what they're doing and maybe loses their money or does something that causes their IRA to get disallowed. They're not going to be happy, and sometimes they're not sure why it didn't work out for them because they just weren't educated.
Sure. No, amen to that. Nobody wants to have the cranky customer. I got you. I got
That's
you.
right.
Well, Terry, go ahead and share with us the best way to get in touch or to connect with you.
Great, I'd love to. As we said at the beginning, I'm CEO of Sunwest Trust. So if you go to sunwesttrust.com, there you can click on the Contact Us button and mention this podcast, and that will get to me, and I can answer any questions you've got. Also on that website, you can request my book, and you can either download an ebook or you can request the actual book. Some people might be interested in why I called it If All You Have Is a Hammer. And the reason for that is I look at self-directed IRAs just as another tool that you can use to build your retirement. And so if you're using, on the cover of the book, it's got a hammer trying to drive a screw in. Well, that's the wrong tool for what you're trying to do. So a self-directed IRA is just another tool, and it's a tool that someone might use or someone might choose not to use, and that's fine. No. So that's good. And then again, going back to Sunwest IRA on YouTube, we've just got a ton of information there. The bad thing about that is you have to look at me because I'm the only. Actually, my oldest son did some of the videos for me a few years back, but the majority of them are me. So, but you only have to, it's only 5 to 7 minutes long. So.
Well, I'm sure the content's worth that, and if they can't stand to look at you, I got more problems than that. So. But, well, Terry, this has been very educational and enjoyable. I really appreciate you taking the time, and hope we can do it again soon.
Sounds good. Thanks, Darren. I appreciate it.
All right. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.